When you tap that button to unlock extra cash through a financial app like Current, it feels like a lifesaver in the moment, but the exact mechanism of how that money leaves your account later is where most people get caught off guard. Money moves behind the scenes under a very specific set of rules, and if you do not understand the automated mechanics of current repayment, you risk running into unexpected drained balances, missed bills, and a cycle of short-term borrowing that is hard to break. At its core, current repayment operates on a system of automated priority retrieval linked directly to your incoming funds. Whether you are using a feature like Paycheck Advance, an overdraft protection limit, or building credit through a secured card setup, the app does not wait for you to log in, review your budget, and manually send a payment. The moment an eligible direct deposit, electronic transfer, or mobile check clearance hits your account, Current system immediately sweeps those funds to clear your outstanding balance first before releasing the remainder to your available spending balance. This automatic sweep creates a psychological trap for many users. You receive your paycheck notification, open the app expecting your full hard-earned income, and instantly notice a chunk of it missing because the repayment triggered millisecond after the deposit landed. If you took out a $200 advance to cover groceries last week, that entire $200, along with any optional tips or expedited transfer fees you agreed to, is deducted instantly. What remains is a smaller primary balance than you originally budgeted for your recurring monthly living expenses like rent, utilities, or insurance. The primary fear most people experience with this model is falling into a rollover loop. Because the app automatically sweeps your fresh deposit to repay the previous advance, your net spending power for the upcoming week drops significantly. To make ends meet and pay your basic bills, you are forced to request another advance almost immediately. The algorithm sees your consistent direct deposits and approves the new request, but now you are simply working to pay off yesterday's spending while relying on tomorrow's money. To break down the technical process step by step, the system monitors your account for qualifying direct deposits, typically defined as recurring payroll or government benefits. When you initiate an advance, Current effectively front-loads a portion of that expected income. The repayment trigger is tied directly to the ACH transfer network detection. Once the network signals an incoming credit to your routing and account number, the internal ledger automatically routes the owed portion to settle your liability. If your incoming deposit is smaller than the total amount you owe, the system will pull whatever total amount is available, leaving a zero balance, and then capture the remaining balance off your very next deposit. When it comes to credit-building features within the platform, repayment works on a slightly different, safer structure known as a secured ring fence. Instead of letting you spend money on credit and billing you at the end of the month, funds are set aside in a locked spending pod as you make everyday purchases. When the monthly statement closes, the app uses those pre-allocated, ring-fenced funds to automatically pay off the balance. This ensures an on-time payment is reported to the major credit bureaus without the risk of you overspending or accumulating traditional revolving credit card debt. The single most actionable takeaway for managing this repayment structure effectively is to treat any advance or overdraft feature as a genuine emergency brake, not an extension of your weekly income. If you find yourself relying on automatic repayments every pay period, you must create a manual buffer. Take a temporary reduction in your discretionary spending for 1 to 2 pay cycles to absorb the automatic deduction without pulling a new advance out immediately after. By absorbing that initial deduction up front, you disconnect your regular paychecks from the automated sweep cycle, regaining full control over your cash flow and ensuring that your money stays in your account until you decide how to spend it.